When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Fogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Fogan. And now here's Jeff Fogan and Jeff Shade.
Thank you so much. Welcome to Premier Retirement with Jeff Fogan, the radio show that gives you the straight talk and honest answers you need to reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about current events. We'll also talk about the silent wealth assassin, that would be estate tax. We'll answer listener questions, and if we have time, our retirement roadmap consultation. My name's Jeff Shade, and as always, I'm just here to ask the questions. But of course, the words of wisdom and solid advice, they come from Jeff Fogan, founder and president of Premier Retirement Planning and Wealth Management here in Tucson, and also office up in Mesa. Hey, Jeff, how you doing today?
Doing great. How are you doing?
I'm doing fantastic, thank you. Hard to believe that February is upon us here. So let's dive into our show today. We've got a lot to talk about. I'm going to start off with talking about something that's gotten some press here in this last week, and that is the China startup DeepSeek. Could it spell trouble for NVIDIA and the AI stocks? First of all, what is DeepSeek and how does it affect us, or how could it potentially affect us?
Well, DeepSeek is apparently the Chinese version of AI, and then they're involved in the Chat GPT competitive world. And I've been kind of cautious, for a long time about just how overvalued some of these tech stocks have gotten, mainly because we really haven't seen any meaningful competition come into play. And, it's just a matter of time between when NVIDIA triples in price and, they've got a monopoly on the market until other competitors say, hey, we can build a fast chip too. You've got AMD working on fast chips. You've got, I think Microsoft did a deal with Intel to try to get them to do one. Good luck with that. I don't know where Intel's going, but they haven't been a dominant player for a while. And then you've got, of course, every Chinese company is doing what they can to reverse engineer any type of technology they can get their hands on. And I'm sure they've got, all their spies infiltrating, all these big tech companies. I'm sure they can get the technology and try to one-up us. When you've got 1.4 billion people in population, you probably got a chance to find a few more smart guys than we do in the U.S. It's not like they're not going to compete. They're going to come up with some good stuff. So I don't know how you monitor that other than just keep ahead of the curve and always keep dominating the market with the newest and best and fastest. There are some other things, I think, with NVIDIA, some proprietary software that they force you to continue to buy, I believe, that runs their chips. They've had some trouble with cooling their chips lately. And it seems like they're kind of at that point. It's kind of a critical place in their growth curve, is where maybe the growth curve's over and it's just going to be, become a cash cow or kind of maintain their business. I don't know how much more they can grow when they've, become a multi-trillion-dollar market cap company. I know just last Monday they lost just shy of $600 billion in market cap just from the correction after DeepSeek, came out with the announcement that, hey, we've got something competitive. And I don't know how much of that is true competition or how much of that is just the market trying to sell off so that the market makers can dump their stock and the hedge fund managers can dump their stock at a big profit, which they've been doing, by the way, for the last several months, while the private investor continues to buy and believe it's going to the moon, because that's what you're hearing on the news. And that's what you're hearing from the president of NVIDIA when he got him talked in, I believe it was Vegas a couple of weeks ago, and caused some turbulence in the market by saying what was hot, what wasn't hot, what was going to go, what wasn't going to go, and everybody just believes whatever they're told, except the insiders, who are the people in the industry. And it's interesting that there's a lot of institutional selling on NVIDIA. I don't think that they actually sold off the stock other than the fact that they can set the price. When the market opens, they can just say, hey, we're going to set the price, $20 lower than what it was yesterday and see if we can scare the market into selling it to us cheap, which I think is more likely the case than, oh my gosh, NVIDIA's broken. It's not going to, be able to earn its keep. The price earnings ratio used to be 100 plus. Now it's kind of in the 50 range, which is still pretty high, but for a company growing as fast as NVIDIA, and this is the biggest player that drives the market. That's why I'm focusing on the discussion about NVIDIA, is not that NVIDIA is a bad company. It's the thing is it's such a dominant company in its space, in all the indexes, the major indexes, the cap weighted index, that basically sees NVIDIA, and whatever NVIDIA does, the market seems to follow. So it's definitely the trendsetter and the market leader. And if it ends up, getting shorted or sold off in a big way, I think that's going to be a very big catalyst to get the market correction that's long overdue started. I think it's going to start with NVIDIA. And I don't think it, started this week necessarily. I think it's a warning sign, though. It's kind of a shot across the bow saying, hey, look, guys, you're traveling dangerous waters out here. You better be careful because anything can happen. You had other stocks like nuclear growth in the energy field, just in order to create enough energy to power these crazy hot chips and to build the cooling systems to cool these super hot, fast chips. There's a lot of, and to do, crypto mining and all this stuff that, causes a lot of energy use. There's been a resurgence in the idea of nuclear power. And that's been a stock category that went berserk the last few months. And that one sold off big too. I mean, we had companies like Constellation Energy went down like 40 or $50 in a day. And I think continue to go down. I haven't looked at it in a few minutes, but, there's some companies that really, I think got a lot of that excitement and enthusiasm, got a little overbought and are going to correct to a more normal area, even though they do have a lot of future growth potential. So, I think there will come a time when the market becomes sane again. And by the way, the market can stay irrational and stay insane and stay crazy a lot longer than most people can stay liquid or keep their stomach in check. So, just because it's been going good for the last 2 years doesn't mean it's going to forever go good. And it doesn't mean that just because Donald Trump got elected that, there's no chance of a recession. We're due for a lot of things. Recessions typically happen after the yield curve uninverts. We just had that a month or so ago, and it looks like it's permanent. The yield curve inversion typically uninverts within 2 years. Well, it's been 30 months. Okay, so we just had the longest cycle because it was manipulated longer and there was a lot more money in Fed games to play around with that. But it doesn't mean it's not going to happen. The other thing is the market correction or the recession gets full blown after the first 2 rate cuts, and we've just had 2, and the third one may or may not get another one. But what I think is interesting is, and we've kind of got off the DeepSeek discussion, but as far as how all that's kind of waking us up about the market, we've also got the Fed, and we got our own government selling treasuries. Well, if they sell treasuries, drive the price down, it creates interest to go up. So in actuality, first time in 70 years that it's happened where the Fed's lowered interest rate, but interest rates actually went up on anything longer than about 3 months of bond terms. So in other words, they're lowering the overnight rate and the short-term interest rate because it kind of helps, banking and, their own insiders do business at a cheaper rate. Yet the long-term rates are still hurting the economy, hurting the investors, and hurting the true growth of companies that need to show growth in earnings. And they're just not showing that much growth in earnings to justify the prices going up. So again, I think the DeepSeek announcement that, hey, we've got something that's competitive might have woke up the market at least, or many investors to say, hey, wait, are we paying too much? Have we considered competition in the mix here? Have we considered how, overvalued these stocks are for a while? Because, it seems like we're in this complacency stage, which, by the way, in a market cycle is in full blown existence. It just is totally complacent. We're in such a complacent stage. If you look at all the market cycles prior to a crash, we're in a more complacent stage than I think we've been in the last couple of years. I know there's been some complacency and there's been a lot of, once you stop worrying, that's usually when bad things can happen. So we have to always keep our guard up. We're going to get competitors. We're going to get new technologies. We've got a lot of changes coming on. We've got potential tariffs that are inflationary, put inflationary pressures. We've got lower taxes, which may run deficits for a while until the economy can get through whatever cycle it's going to go through and start rebounding again. It reminds me of, just looking at history with Ronald Reagan. He came in and kind of changed the world of economics and, how it's played, the trickle-down economic, meaning, hey, if we support all the entities with lower taxes and things like that support the regular Joe person in America, it'll trickle down to benefit everybody. And it eventually did. But I believe for the first couple of years of his presidency, it wasn't good times. I mean, he came off the back of a, stagflation just a few years before that, and pretty significant inflation. And there was a lot of economic trouble. Even currently, in spite of the fact that the market's doing well, we have a lot of economic trouble. We have things that just, haven't been, our manufacturing hasn't been growing for a long time. We have interest rates so high that people can't buy houses and afford things anymore. We've got gas prices too high for people to go to work and afford that without getting a second job. So there's a lot of things that need to be fixed, but in order to fix it, I think there's going to be, it might seem calm, but I think there's storms ahead, and I think we've got to get through those before we can say, hey, it's easy sailing now.
Talking with Jeff Ogun here of Premier Retirement Planning and Wealth Management in Tucson and Mesa. We're talking about DeepSeek and some current events. Again, anything piques your interest this morning, you'd like to come in and sit down and talk with Jeff about the current events, how they could affect your journey towards a prosperous retirement. Anything else you want to talk about insofar as planning for the growth of your wealth or retirement planning, again, we're offering it no cost, no obligation. Our Premier Retirement Roadmap, and you can get yours by calling 520-780-9059. So I said, no cost, no obligation for this whatsoever, just a casual conversation. So call this number, 520-780-9059, and request your complimentary Retirement Roadmap. Okay, so we talked about DeepSeek. It occurs to me that if we're worried about TikTok stealing information from us because it's a Chinese company, I certainly am not going to download the DeepSeek app to my phone. So anyway, that's just my commentary on that. As you said, Trump has slapped a new country with tariffs. We've heard about Mexico and we've heard about Canada. He slapped a tariff on Colombia because they didn't want to take their migrants back. But then he sort of turned that around a little bit. Colombians sort of had an epiphany there that said, wait a minute. If we don't deal with the U.S., where are we going to send all these flowers and this coffee, right?
What I've said before is, people think, oh, these tariffs are going to cause inflation. I think they're more a bargaining chip than anything. I think if we are going to send all the, illegal criminals back to their countries, Colombia being a big supplier of those, we'll be getting some back. They didn't want them back. And Trump says, well, great. Well, we'll just tariff all your products and you won't be able to sell them here. Well, that would actually cause a lot of inflation in coffee and things that a lot of consumers use. I don't think you'll die if you don't drink coffee, or if you drink half as much as you do. I don't drink it at all, so I know you can live without it. I don't know what that does, but again, it's a choice people would have to pay more for. So, the fact that he has that as a bargaining chip, and the fact that it isn't one of those things like oil that you really need to fuel your cars, heat your houses, and everything else. There's a different story with that kind of a tariff, where other countries might say, well, you're not energy independent, screw you, put a tariff on it. We don't care. You're going to buy it from us anyway. But with those things, the consumer goods, which are pretty much discretionary from Colombia, and they make a ton of their economy from those exports, that's a bargaining chip that Donald Trump can use. And he's a deal maker. He's a businessman. And he used that in order to get them to change their mind about taking back some of their criminals, or some of their undocumented, let's just call them illegal aliens, people that shouldn't be here because they came here without using the process. In fact, I think a lot of these countries, according to Donald Trump, and I haven't seen anything that would contradict that, is that they were encouraged. They have let out a lot of their prisons, and people that otherwise they wouldn't want, say, hey, they're open doors in America, go there, make a living, get rid of you, get rid of the problem. And then, it costs billions of dollars just to support a couple 100,000 illegals in your city. I mean, what's that doing to taxpayers' money? So it's really a detriment all around to us, and it costs us a lot of money to keep them here. And they think, well, it costs us a lot of money to send them back. Well, it'll cost Colombia and other countries a lot of money if they don't. I mean, they did the same thing with Mexico. They wanted to turn a plane around and, okay, well, we're going to start tariffing all your goods. And they go, well, okay, all right, we'll take them. Colombia, on the other hand, I think they even he says, oh, I'll send my jet. And of course he said, well, because I want to make sure it's a humane and, the conditions are up to standard for our citizens. It had nothing to do with that. It was more or less, oh, shoot, you got me. Let's see how we can make you know that we're apologizing in a big way here, and we're going to be team players in this deal.
These ICE raids also rounded up some gang members. 5 Tren de Agro members were rounded up in Chicago, and those are some pretty bad guys there. They're involved in bribery and drug trafficking, kidnappings, ransom, money laundering, and where there's 5, there's probably at least 25. So the ICE raids, in some respect, are certainly doing their job. Talking with Jeff Ogun of Premier Retirement Planning and Wealth Management. I want to wrap up this segment by talking about something that doesn't have to do with finances. Kansas City Chiefs back in the Super Bowl again. This could be a three-peat, this time against the Philadelphia Eagles. Do you think that there's any chance, Jeff, that the Kansas City Chiefs do not win that game?
I don't know. It seems like it's been orchestrated throughout the season. They barely win the games they win. They come up and say, oh, yeah, but we do just enough to win. That's why we're a great team. It's, they don't blow anybody out. And it always comes down to a few critical plays that I think you can look at the refs and go like, what were they thinking? Is this really them? And I hate to be a conspiracy theorist, especially in football, a sport that I like, but I know a lot of people that are just not watching anymore. My son is crazy about just how one-sided or how critical. Yeah, now, they make bad calls both ways, but the bad calls that go against the opposite team that's playing against Kansas City always seems to be at the critical moments, like, a third down that's misspotted and another fourth down that's misspotted in a critical situation where they need a first down, and there's a turnover on downs and go into the end of the game tied. And if it hadn't been a turnover on downs that they scored on, it would have been probably 6 or 7 points the other day. It wouldn't even been a tie and gone down to the wire. So I'm just talking about the Buffalo game last week. I hate to think that it's not true competition, but I think the NFL is all about ratings. It's all about the money. It's all about the more they can get screen time with Taylor Swift, the better, the more they can get, the story about the three-peat and the Heartland of America team that just comes up and wins. And gosh, they just work so hard. They barely eke out the win, but you can't just barely eke out wins and win by the least point margin in the league and be a dominant team. So how is that happen? They just coast and just do enough to win because they're that good, or are they getting a little help along the way? A lot of teams that have played them consider that they've gotten help along the way, and they're getting fined for speaking out about it. Finally, there's other commentators that are scratching their heads and can't believe, what's happening either. So I'm not the only one that's talking like that. But having said that, as long as they get the story of the three-peat and they get the Kansas City Chiefs in the Super Bowl, they're going to get all the marketing and all the dollars that they need probably for that. I know that the franchise, in Philadelphia is a decent market, but nothing like it would be for an LA team or a New York team or a bigger market team to be in that game. But they can build enough around Taylor Swift and the three-peat story and, Mahomes being the greatest ever and all this kind of stuff, which, by the way, I don't believe. He's got a long ways to go to catch up with what I think Brady's accomplished. But, I think that it wouldn't be a bad idea for at least the football to allow them to lose the Super Bowl, or at least a ref more failure, so that if they do play on even ground, I think the Eagles can beat them. I think Saquon Barkley is incredible. I don't think there's anybody on the defense, that's going to, stop him from gaining 100 plus yards and scoring touchdowns. So, they've got to come up big to beat the Eagles legitimately. We'll just see how many flags are thrown on critical plays and how it plays out. But I think the NFL did its job by getting as many games as they could with Taylor Swift on TV and that skybox. And they're going to milk the Super Bowl too. So, once that game's over, I don't know that it matters who wins, because I don't think the story about a four-peat, that's getting a little bit too redundant. It's just kind of like too much. That shouldn't happen. But maybe they let them three-peat and then they won't be a team anymore next year. But it might start this year. And the other thing is if a team plays well enough, they can outplay the refs. So, that's one thing that hasn't happened. Unfortunately, Kansas City is good enough to keep all the games close enough to win on those plays that are questionable. But anyway. That's my take. It's probably too much pontificating about my theories about football.
I was going to say, Jeff, maybe we should do a sports talk show and another hour on this radio station. I don't know. Super Bowl.
They'd levy a fine against me for complaining about the refereeing.
Super Bowl 59. It's going to be Sunday, February 9th. It's going to be, 5:30 Central, 6:30 Eastern, and a few hours before that Pacific. Anyway, that's going to be one game that a lot of people might be the only football game that they watch. And halftime show, I don't know even who's doing that. Nevertheless, if you'd like to come in and sit down with Jeff, talk about your journey towards a confident retirement, 520-780-9059. We are offering this retirement roadmap for you, no cost, no obligation. We'll take a look at what you have, where you are in your journey towards retirement, and offer some suggestions for that. No cost, no obligation, 520-780-9059. We're on for you 4 times a week, Saturday 7 a.m., also 9 a.m. and 1 p.m. We're also on Sundays at 11 a.m. If you have missed us any of those times, once again, remember, we're also a podcast. Boy, we've got a lot of podcasts up there these days. Simply go to wherever you get your podcasts, where all good podcasts are heard. Search for Premier Retirement with Jeff Hogan. You're going to find this show and many, many of our past shows so you can stay on top of your journey towards a confident retirement. You can also find out more about us online at premret.com, Premret.com. Jeff, let's continue our conversation by talking about the silent wealth assassin, and that would be the estate tax. A lot of people are not aware of the fact that this is also called a death tax, and when you die, you may be subject to tax on what you leave behind. So can you explain what the estate tax is and what the limits are this year?
Well, the government's really good at redistributing our wealth. That's kind of what they do, but they really whack it to people that don't do a good estate plan. When I first got in this business, the level of estate taxes started at an estate of $600,000. Then it got raised to $1 million, and then it got raised a little bit more, and then now it got raised to $10 million. There was actually, I think in 2010, there was actually an exemption. You could die without any estate taxes for a small window in there, which happens to be when Steinbrenner, the owner of the Yankees, actually died. And I think he passed on $1 billion franchise with no estate taxes, which reminds me of a football story. You know, the Joe Roby Stadium, I think it's what they named the stadium in Miami. Right. The Roby family owned the Miami Dolphins, and they were required within 9 months to pay an estate tax. They couldn't do it. They had to sell the team in a fire sale, and all they got left was the name on the stadium. So lost, potentially the future value of billions of dollars of what that franchise would become worth 20, 30 years ago or whenever that happened. And, lost a ton of wealth. I mean, if you not only, and by the way, the estate tax starts at around 40% and goes up. At the time, it was going up to 55% and then a surcharge where you could actually pay 60% on the amount over and above the million or two that, was originally in the estate tax levels. Then they started raising it to $5 million per person. So it's $10 million was the estate tax exemption. Then they've given kind of a cost of living adjustment to it currently. I mean, if you died this year in 2025, the limit is just shy of $14 million per person. So if you're a married couple and put things in trust and, use kind of a two estate combined situation, you've got just shy of $27.98 million. That's what you can die with without getting estate taxed. After that, like if you have 30 million, then you'd have a couple million that would be taxed starting at 40%, be $800,000 in taxes. Well, maybe not that big deal for a $30 million estate, but what if you have 100 million? And have to give up $30 or $40 million in estate taxes? Where are you going to get that if all your money's tied up in property and things that are illiquid, a sports team or something like that? Now, I know many of the people listening don't have $100 million, so this might not be relevant. However, and I think for a long time, the estate tax discussion for somebody who comes in here with $1 million or $2 million or a few $1 million estate, even up to $10 million, they're thinking, well, I don't have to worry about estate taxes. Shoot, we've got a $28 million exemption. I mean, we'll never get that. We'll spend some of the money and give it away, and we're not going to have to worry about it. But guess what? For the last few years, there's been talks about making it like a $4 million per person, which would get us to $8 million. There's a $6 million combined limit, a $7 million combined limit. So let's just say it's somewhere between $6 and $8 million. And you have a $3 million estate right now, and you've got enough pensions to pay your living. And the only reason you have a few $1 million in your retirement plan is because you've been a really good saver and really hard to spend money. You probably are the same way in retirement. That estate, let's just say 6% a year on that money, you're going to double that every 12 years. Well, if you're 65 when you retire, that 3 million could go to, by the time you're in your mid 70s, go to 6 million and then another 12 million. So just say you have a 25-year retirement and your estate doubles twice, you might have an estate tax on, let's say, 6 million of that money. What do you do? How do you give it away? How do you estate freeze? You can start spending it now or just learn to spend money, or you can start setting aside in trust. And there's a lot of techniques that we can use. But bottom line is, you've got to figure a way to make your estate free so that it doesn't grow higher than that $6 million range. Some people even talk about $4 million, especially if you're single. It might be a little bit less than that $6 million per individual that they're kind of batting around. It might be even less. But let's just say, you do have a few $1 million in your estate, and, inflation's going to be a little higher than the 2% that they had hoped. And, that means your values of your real estate and other things will probably grow a little faster than you're expecting. So people always get surprised at how fast their estate grows in retirement. You get to retirement, barely enough to, retire on, you think, but if you don't spend it all, it continues to compound. And if you're frugal or if you're responsible with your money, it's amazing how that the trajectory of that growth curve can become late in life. And the government's just waiting to take a chunk of your money. So it's wise to look at those estate taxes, especially if your estate is in the millions or even starting to get past there. Look at the growth rate and look at the projections 25, 30 years down the road if you're at the brink of retirement, and use those numbers to figure out what you might want to do to minimize those estate taxes. I mean, nobody wants to pay a few $1 million of their hard-earned assets that they could have spent but didn't spend and just hand them off to the government so they can give them to who knows who for who knows what.
Jeff, I want to talk about this a little bit more after the break here. We do have listener questions, but I do want to talk about some of the ways that you can avoid estate taxes if possible. But we do have to take a break here in just a moment. So if you're listening right now to the program, we do have listener questions coming up. We'll also talk about ways to battle this estate tax issue. But in the meantime, if you'd like to sit down with Jeff and talk about anything that relates to your retirement, it could include estate taxes, call 520-780-9059. Phone line is open right now. Leave your name, telephone number. Shelley will call you back during the week and set up a time for you to sit down with Jeff and talk about what you want to talk about. No cost. No obligation whatsoever, just a fact-finding mission for you to get the answers that you need to put you on a path towards a confident retirement. Again, 520-780-9059. You can also find out more about us online at premret.com. Jeff, time for a break. When we come back, we've got listener questions and more when our show continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Hogan and Jeff Shea.
We so much appreciate you joining us each and every week for Premier Retirement here on 790 KNST. Once again, we're on for you 4 times a week. Saturday, 7 a.m., also 9 a.m. and 1 p.m. We're also on Sundays at 11 a.m. If you have missed us any of those times, once again, remember, we're also a podcast. Simply go to wherever you get your podcasts, where all good podcasts are heard. Search for Premier Retirement with Jeff Hogan. You're going to find this show and many, many of our past shows so you can stay on top of your journey towards a confident retirement and have something worthwhile to listen to. Okay, Jeff, listener question time. We'll get to those estate planning issues a little bit later on in the program again. But I want to start off with our listener questions. The first one from Russell, listening to us in Tucson. Russell writes, I want to donate to my favorite charities, but I want to find the most tax-friendly way to do it. I have heard about these things called QCDs. What are they, and how will they help me save on taxes?
You have to be old enough to do those, but that is a good question. I don't know how old you are. Based on your question, you didn't include that. But once you're 70 years old, you can give to a charity the required minimum distribution from an IRA account. You can actually give more than that if you want to. But if you want to give money directly from a qualified plan that would normally be taxable to you, for example, let's say you make $100,000 and you want to give 10% to your church as a charitable deduction. If you take $90,000 is from pensions and Social Security, $10,000 is what you're taking out of your IRA. $100,000 is your income, and then you have roughly a $30,000 standard deduction on your tax form. So the $10,000 that you give your church doesn't end up being a tax deduction unless you have other things that are deductible that make up that $30,000. It gets buried and you don't end up getting a write-off. You just help the charity out and, oh well, whoop-de-doo. If you were to take that $10,000 out of the IRA and have it directly sent from your IRA company, let's say you have it at Fidelity and you want to just say, hey, Fidelity, send my $10,000 over to the church. Here's the number to credit to, my charitable account so that they know that I gave it to them and get my brownie points or whatever, if you do that, or you just send it to them. And then because it never came to you as income, now your income starts at $90,000. You don't get a 1099 sent to you as $10,000 in retirement income, so it doesn't show up on your tax return as in the adjusted gross income column. You would have $90,000 there minus the 30. Now you paid $10,000 less in taxes. That could save you $2,500 or so in taxes. So you actually get your deduction. A lot of people, give even more than that. There's another thing besides qualified charitable deduction that you could do, and that is called the donor advised fund. Let's say you're making a few $100,000 a year, and you want to give $10,000 a year to your charity, Heart Fund, or whoever for the next 10 years. But you know that $10,000, and let's say it's not IRA money or qualified IRA money or 401k money. Let's just say it's money you've saved and keeps growing, and you get these surprise 1099s every year because the mutual fund made money or didn't make money, and you don't even know what your tax bill is going to be. So you decide, you know what, I want to give some of that money to a donor advised fund. Let's say you're making $300,000 a year and you put $150,000 in this fund. You can deduct the $150,000 or whatever the limit is on donor advised funds. It can be between 30 and 50% depending on how you set them up. But let's just say you put the $150,000, let's just say $100,000 in this donor advised fund. It's a deduction that year. So you more than cover the $30,000 in standard deduction. You get a deduction, the extra 70 or 120 or whatever it is that you put into this donor advised fund. You get all of it right up front. And every year you tell the donor advised fund to send that $10,000 to your favorite charity or more or whatever it is. That fund can still be invested and grow. You just don't have access to take it back anymore. You basically give it to a donor advised fund where the trustee pretty much does whatever you say. And that's a way to only have that standard deduction hurt you 1 year, because then the rest of the years, as you give that $10,000 deduction from that donor advised fund, again, you don't have to include that on your tax forms. Now, in order to get those big chunks of money, you either have to have a consistent high income, or you do it right before retirement while you're still in your high earning period, where maybe you're making $300,000 or $400,000 a year, and you want to do these donor advised funds with some of your savings to basically cover your charitable gifting for the rest of your retirement. You could do it up front and get a huge tax deduction while you're making that kind of money. And then maybe you're comfortable because you have no debt living on 100 or 120 a year and being in a 12 or 15% tax bracket after other deductions that you have, and cost of living adjustments, things like that are going to be made. So not just QCDs, think of donor advised funds, DAFs, what they call them, but there's a lot of other things that you can do as far as making those tax deductions count. We can even use LERPs, where you can borrow the money from a death benefit and get a tax deduction against your tax returns, but not get a 1099 for the income, because it's a loan against your death benefit, which is tax-free. And when you die, it all comes reconciled, and that also stays off the books and keeps your estate from growing. And anyway, there's a myriad of things we can talk about tax planning, but that QCD is a great start. And if you want to know more, schedule an appointment with us. We'd be happy to take you down the road of all kinds of cool ways to give to charity and make it count for you.
And Russell, that telephone number, 520-780-9059. Thank you for that question. We'll send you out Jeff's book, Retirement: The Road Ahead. Next question is Brian in Vail. Brian says, our financial advisor is the same one who has worked with my grandparents, my parents, and my aunts and uncles since the 80s. I recently asked the advisor at our company 401k to look over our portfolio. He says how we're allocating the money is fine, but it's definitely old school, how it was done a couple of generations ago. It does not take advantage of modern options. I feel an obligation to stay with our old advisor, but also want to be current. Is there something that I should be concerned about with this old advisor and his techniques?
Well, I think you need to be comfortable with whoever you're dealing with. I don't think you're obligated for anybody. I mean, they might think they are because they had your parents and grandparents, but guess what? They're more that style. If you want to do a different style of investing and this guy's not comfortable with it, then you're not a fit. I think you need to be a fit. I have, on occasion, I have a client after a year or two, they don't want to follow the plan and they decide to get a new advisor, and it's not a fit. We don't jive anymore. The plan looked good a few years ago and it doesn't. I mean, I'll admit, on occasion, we have somebody that's just like, this isn't working. We want to do different things, maybe that I'm not comfortable with. For example, the last couple of years, the market's been going crazy, but I think I want to be cautious because it's not about growing your estate as much as it is as protecting and preserving it for your future. And that's, in my opinion, my number one priority as an estate/retirement planning professional. If you have tons of money and you can afford to lose some, then get in the market. But I've had clients that kind of changed their mind. I didn't feel it was very comfortable. I'm not really an NFT or a crypto guy, but if you are, we're probably not a fit. And that's totally fine. I want to deal with people that get up happy to work with me. And as soon as they're not, go find a new guy. I mean, it's totally fine. If you're not happy where you're at, go find a new guy. Whether it's us, whether it's somebody else, you need to be happy. I mean, money is too big of a deal and too important of an aspect in your life to, your retirement. It's not like life's too short to be miserable, but your retirement should be long and happy, not frustrating and, wish you could have, would have done other things. Now, there might be a case where this old school person is like me and doesn't want to take a lot of risk as you near retirement. Maybe that's their philosophy, and maybe you ought to ask them to share the philosophy of why you're not in the NFTs and other things that you want to be in. And yeah, sometimes they have higher fees and maybe other advisors have higher fees. In some cases, we have higher fees than other advisors, but it's not about the fee. It's what you get out of it. We do tax planning. We provide discounted tax preparation services. We provide discounted trust and estate planning. We look over the whole plan. We do annuities and life insurance where we get a commission, but we don't get ongoing fees. So maybe the fees on a smaller portion of it is still less than you would pay anywhere else, but the value you're getting is much more comprehensive. You have to look at all that. If it's just a matter of, you parked your money someplace and somebody's getting a fee and you could have parked it yourself, I wouldn't pay a fee at all. I mean, if that's what you want to do, if you just want to buy your own stuff and you have your own ideas of where you want to put your money and you're willing to take the risks associated with it, then why are you even paying this guy a fee? I mean, he got a fee from those people he served in the last couple of generations, it sounds like. So do you really have to have this guy? I'm surprised the guy's still at it if he's been able to serve your family that long, but they must have started with him when they were very young, and maybe he just loves the business like I do and probably never quit. But it's up to you. You have to be happy. And if and people change, sometimes people want a certain thing and a few years later it changes. And if you and your advisor are really not on the same page, then either find a way to get on the same page and get comfortable again, or do it yourself, don't pay the fee, or find somebody else that floats your boat and, can be a better team player for you.
Brian, we appreciate that question. And if you'd like to bring your portfolio in and have Jeff look at it, Again, call 520-780-9059 and set up that appointment. No cost and no obligation for that. And of course, we'll send you out Jeff's book, Retirement: The Road Ahead. Our third question today is Dan listening to us in Reeder Ranch. Dan says, due to an auto accident, I've been given a settlement of $375,000. I can still work, but I'm not sure of my ability for a long time. I'm 51 now and wanted to work until 67. I'm married with no children, but have a spouse who does not work. I have $92,000 left on my mortgage and have about $125,000 in a 401k at work. My question is, what can I do with this windfall to ensure that it goes as far as it can in retirement if retirement comes sooner than expected?
Well, I hope if retirement comes sooner than expected because of some sort of a disability, I don't know if the auto accident had anything to do with work or not. There might be some sort of a disability insurance through that, or some sort of disability program if you didn't have any. I don't know if there's a way to get a little bit of help there to buffer the difference between, what you can make. But, you want to get to 67. I get that. You have a spouse which doesn't work. Maybe it's time while you work to have her go back to, school and get a degree in the next couple of years where she could be a support or whatever. I don't know. It's 92,000 left plus 375. That's hard to stretch into retirement at 51, knowing you won't get Social Security till at least age 62, especially when you have a mortgage. So, I don't know what the mortgage payment is, but, the 92,000 left, maybe if it's a low rate mortgage and you can invest your 375 in something with a higher return, then I would definitely keep the mortgage and not worry about paying it off. However, if you stopped working and that payment became a burden and you had to stop working before it was paid off, maybe it's down to 20 or 30,000. Hopefully that 375 is going to 400 or 500,000. Then you pay it off, get out of that payment, and then you can make ends meet on the rest. Now the 401k at work, I don't know what your income is, but you might want to try to max that out as best you can too. And keep in mind, a 401k, if you retire, you can start liquidating and using that money in retirement at age 55 without penalty, unlike IRAs, which the age is 59 and a half. So at 55, if you're terminated or separated from your work, a 401k is available to live on. You might want to even look at, just depending on how much liquidity you need, you might want to even look at some income annuities that guarantee income, at age, let's say 60 or something like that. And it's tax deferred while you're letting it grow. And it would give you a guaranteed income, maybe of $30,000 or $40,000 a year on top of what your 401k can become and Social Security can provide. So there's a few different options. I have just a gut feeling that if you have to retire before you're in your 60s at least, you're going to have a shortfall and probably have to live on less than you're used to living on now. And that's just a condition and a fact. So I don't know what your house is worth. If there's some equity that you can downsize, take that out, do a reverse mortgage. There's all kinds of options we could talk about. I don't have enough information to build a whole plan on. But I think that might be worth a look now that you have a significant dollar amount to play with or to plan with. I think, putting a realistic plan to when, certain situations might arise where you can't work anymore. Do a plan for what if I can make it 5 years, but I can't go 15, or what if I can, go 10, but, not make it to 67. And if I can make it to 67, how aggressive do I need to be between now and then? So, we can do some different scenarios for you. I don't know. Most advisors just kind of are portfolio managers and invest and say, yeah, we should be able to make this and it might do this. And it's just kind of a hold and hope and invest and let's see what the market does for you. And we'll just have to decide what your retirement is when you get there. There are more guaranteed or predictable ways to plan income. And I think with the amount where you're looking at 500,000 so far that you could, plan for the future, you're at a place where you ought to start putting those numbers down and planning. You're in your 50s, you're probably 10 years or more from retirement normally, but like you said, you might be a little quicker to that date. So I think putting some numbers on a plan is pretty important for you.
Dan, thanks for listening to us there. Once again, call us and sit down with Jeff. And, we do have some other things we need to ask you. 520-780-9059. It's not going to cost you a dime to do that. We appreciate you listening to us in Reeder Ranch. If you've got a question you'd like us to answer on the air, you can get it to us by calling it in to Shelley. She'll take it down at 520-780-9059. You can also use our contact page at premret.com. If we use your question on the air, not only will you get a great answer, but you also get Jeff's book, Retirement: The Road Ahead. Okay, you're listening to Premier Retirement with Jeff Hogan. My name is Jeff Shade. Glad you could join us again this week. And again, that same telephone number that I told you just a moment ago, 520-780-9059, is the number that you can use to get your own retirement roadmap with Jeff, no cost and no obligation. Make that call this weekend. Leave your name, telephone number. Shelley will call you back during the week and set that up for you. Jeff, early in the program, for those people just joining us, we did talk about estate taxes, the death tax, and the fact that it is quite large now. but it could be coming down here within the next 4 years. We just don't know about that. So for those people who are worried about estate taxes, Jeff, what are some of the ways that we can reduce our estate while we're still living?
Well, most people do it through, first of all, through a trust. If you have depending on how they rewrite the law on the estate taxes, right now, if you're a married couple, let's say you have $10 million, let's say husband dies, the wife would then be the recipient of $10 million. When the wife dies, she's got a $10 million estate. So as a single person, she's got to speak to the whole $10 million. So if they lower, let's just use a round number of $5 million, if they lower the estate tax level to $5 million, and everything over and above that you have to pay tax on, well, she just has to pay tax on the $5 million that she had extra. Well, what if you do what's called an AB, or a credit shelter trust? It's basically a living trust where you get control of all your assets. But by the time when the first spouse dies, you have what's called, I always remember AB trust, meaning above ground and below ground trust. So the B trust gets funded with half the estate from the spouse. Now, I would put, from the first spouse that dies, I would put things that are very possible to appreciate that will, grow more, maybe some aggressive stocks, maybe some real estate, things like that. You might want to just put in that person's estate. Whatever that estate grows to between that death and the final death, it's already been spoken to as one of the credit shelter of that particular spouse who died, which is $5 million. It can stay there in trust and pass on to the ultimate beneficiaries after the second death of the spouse with no additional estate taxes due. Now, on the other spouse, the other $5 million would go into a trust for her, because husband dies first, the wife is the A trust, would have access to the $5 million, would also have access to any income or growth off of the B trust from the husband, and would take the income. So let's say the $5 million generated a couple $100,000 a year in interest, but didn't really grow much. She could spend that and keep it at $5 million. However, if it's growing at 6 or 7%, and the assets are going to continue to grow and push past that estate tax level, then it will be smart for that spouse to either gift to all the kids an extra right now it's $19,000. I don't know what's going to settle in at, but it's $19,000 per spouse per child. Let's say both spouses are alive and they're young, and they know that they're going to get into an estate tax problem in the future. It would be very smart for them to start giving that $19,000 a year to their kids. But what if their kids are minors? What if their grandkids, aren't old enough to use it for anything responsibly, and you don't want to just hand it off to them? You can do what's called an irrevocable trust, where you can actually gift that money to the kids. They can disclaim it through what's called crummy powers, which is a family name of why the law came into be. It's not a crummy trust, but it's a crummy trust named after the people. But the powers are that you can disclaim the gift and put it in a trust for later. What many people do, I would say most people, the easiest way to do this would be to put it into an irrevocable life insurance trust, where those $19,000, let's say you have 10 kids and grandkids, that's $190,000 a year per spouse that you could put into this trust. And if you bought life insurance, maybe you could buy, $5 million in life insurance that's tax-free, and it goes estate tax-free because it's outside of your estate. So you can fund the excess in trusts, and we use those very often, especially now that we know that estate taxes are going to probably be dialed back from the $30 million level that they are now to more of a range where more people will be hitting that level in a decade or two. We're starting to see a revival in the need for those estate tax exempt trusts or irrevocable trusts. Typically, we like to put life insurance in them because the asset grows tax-free. If you ever needed money, you could borrow against it tax-free. It doesn't cause a tax event. In other words, there's nothing that you would have to file a tax return for or get a 1099 for. So life insurance is definitely the easiest asset to use. What most people do. But you can also, just gift money to kids and just say, hey, every year we're giving you $19,000 so you can go to Disneyland with your family, do whatever you want to. And it's, one way estate freeze. I mean, we like to give large Christmas presents to our kids because not only do they need it, but it helps our estate from growing too much. It's money that we'd probably just hand them later, only with a 40% discount if they estate tax me. So, when we pass away. So bottom line is there's some other things. And what if you don't have a bunch of kids? You can also do a charitable remainder trust. I've got some people that, invested years ago in, let's say, Apple stock or Microsoft or something 20, 30 years ago. And even though they didn't put a whole lot in it, they never sold it. Now it's worth 10 million or more. Well, that IRA is going to cause a huge problem with, estate tax, not just estate tax, but also income tax issues come time to take the required minimum distributions out. Well, you could do what we talked about earlier in that question and do some direct charitable contributions, and then that would not count as taxable event. You could give your required minimum distributions to a charity. You could also have a charitable remainder trust where whatever the remaining balance of that trust goes to charity, but the charity continues to pay your kids and even one more generation down, grandchildren, a certain percentage return. As long as the charity gets to keep 10% of the original balance when it's placed in there, you can actually gift back the other 90% over time with interest and growth to where it's a lot more efficient, and you get a tax benefit from that. And because it's a charitable remainder trust, it isn't included in your trust. And you could do that upon your death. You can actually set it up to where the death is what triggers the gift, so you can still keep more or less control of that asset, change the charities at will. If you give it all to a charity now and you'd end up not liking the charity, I had a friend that was a lead endowment council lawyer for Boy Scouts, and he had a lot of people that wanted to leave a lot of money to Boy Scouts, and they did these charitable remainder trusts where it was already committed. Now that Boy Scouts has kind of changed their value system, those people wish they hadn't done it. So if you do a charitable remainder trust, leave it flexible so that the charity can be decided upon your death or decided by your trustees, and that money, whatever's given to a charity, even though it may spin off income to your children over a period of time, unlike most IRAs, which have to be depleted in 10 years under current law, the charitable remainder trust can be depleted over a much longer period of time, decades, maybe 40 years, that in order to actually spend all that money. In the meantime, it grows and your children and grandchildren get paid a lot more of your money on a tax-favored basis than they otherwise would. Again, this is, for a little higher level estates than the typical, Joe who works a 9-to-5 job and retires with a nice little 401k. But, if you've done some investing where you have some real estate or you have these highly appreciated assets, qualified assets that are going to kill you, when you get to your 70s and have to start taking that money out when it's forced upon you, you might wish you knew a little bit more about the charitable gifting strategies through trusts.
If you have questions about the death tax, the estate tax, and ways to mitigate that, again, call Jeff here at Premier Retirement, 520-780-9059. Sit down and have that discussion. And as you said, Jeff, trusts are a great way to do that. You're listening to Premier Retirement with Jeff Ogen, founder and president of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. Jeff, just a couple minutes left in the program here today. We talk about this retirement roadmap. People can get it no cost and no obligation. Can you explain a little bit about what that consists of?
Well, it's really like I mentioned earlier in one of the meetings, it's really kind of a see if we fit meeting first, and we start just making sure that our values align. I mean, if you're a retiree that wants to swing for the fences and put all their stock in, one stock because you think it's going to the moon, I'm probably not I'm going to lose sleep over that one. So we're probably not going to be a fit. If you want to preserve your assets and you want to have a comprehensive plan where it's tax efficient, you can count on income coming in every month, and you can know that it's going to get to who you want, how you want, when you want, with the least amount of trouble. Okay, we're at least start on the right page. And so it's fair that you would ask that question. We have an income plan, an investment plan that fits the income that you'll need without undue risk. We want a tax plan where we might use anything from municipal bond portfolios, which are tax-free interest, and to a certain degree, we have Roth conversion strategies where you pay taxes now and don't pay taxes ever again on that Roth money. We have life insurance, which is a tax-free product as well, that it can be very efficient and even look better than a Roth if you're healthy enough to get insurance. In fact, some people when they get a little older aren't, but we'll do Roth conversions. The other thing that we like is annuities are tax deferred for non-IRA money. If you want to be more in control of what you pay in taxes, indexed annuities that go up with the stock market but don't go down and are principal protected might be a nice place to get that extra income you need from, and you can manage your tax bite a lot more effectively if you know how much you're pulling out and what the taxes would be on that amount. In other words, you only pay tax on the money that you make when you pull it out, rather than a mutual fund portfolio where you might get a surprise every year. So depending on how much of your money is in IRAs and non-IRA type of accounts would kind of dictate the strategy of the approach that we would take. But we do a comprehensive plan. We first of all see if we like each other, see if our goals align. Then after we draft a plan that is more comprehensive, you see if you like it, we tweak it a little bit. Ask your questions, and after 2 or 3 visits, we decide if we want to be friends and move forward. Either way, we'll be friends, even if you don't stay here. But I say that kind of tongue in cheek. But if we want to work together, I want to make sure that I'm comfortable with you and where you want to be, and I want you to be comfortable with me and our firm and what we like to do as well. And that's why we have very low turnover here. I mean, I think it's if we look at on a yearly basis, probably less than 1%. I think in the typical financial world, it's about 20%, which means people change advisors on average about every 5 years. If we have a comprehensive plan where you have predictable income and you're saving as much taxes and you're having somebody look after that entire plan and not just manage your portfolio, you're going to be probably a little less fickle. You're going to be a little more satisfied and be a little bit more committed to a plan because you see what it does for you year in and year out. So that's really in a nutshell what the plan is. There's 5 pillars of planning, income, investments, taxes, how are you going to cover long-term care and those unforeseen medical expenses that might bite off a chunk of your estate if you're not prepared for it. You might want to even find tactful ways to use your equity in your home for those costs, or even to live off of. And then we want to make sure that the estate plan is set up to make sure your estate gets to who you want, how you want, without probate, without taxes, and without any trouble.
If you'd like to take advantage of the opportunity for this retirement roadmap, call 520-780-9059. Do it this weekend. Shelley will call you back during the week and set up that appointment for you. Once again, it's 520-780-9059. Jeff, out of time for this week. I want to thank you for your time, but most importantly, I want to thank our listeners for joining us. So for Jeff Hogan, I'm Jeff Shade. Have a great weekend. Join us again next week right here with another edition of Premier Retirement on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy, and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.